How does the PEG ratio impact investment decisions and stock valuation? Welcome back to the Plan Future Insight. I am Investment DADA, and today we are going to talk about a question that truly separates thoughtful investors from the crowd. You asked about the PEG ratio, and I am genuinely proud that you are digging into the nitty-gritty of stock valuation. Let me break this down simply for you. The PEG ratio is the price to earnings ratio divided by the earnings growth rate, usually taken over 3 to 5 years. Rupees think of it as the PE ratio adjusted for growth. A stock with a PE of 30 might look expensive, but if its earnings are growing at 40% annually, the PEG ratio is just 0.75. Suddenly it is a bargain. Now, here is the DADA framework for understanding PEG. If the PEG is below 1.0, the stock is undervalued. It is growing faster than its PE suggests, a potential gem. If it is between 1.0 and 1.5, the stock is fairly valued. Growth justifies the price, and you can consider accumulating through a systematic investment plan. If it is between 1.5 and 2.0, the stock is overvalued. The market is pricing in too much optimism. Keep it on your watch list only. And if it is above 2.0, it is highly overvalued, often a sign of hype. Avoid it unless the company has an exceptional moat. However, DADA's 20 years of wisdom says the PEG ratio is a powerful filter, but you should never use it alone. Here is why. First, do a quality check. A low PEG means nothing if the company has high debt, negative free cash flow, or poor management. I have seen dozens of stocks with a PEG of 0.5 destroy wealth because their quality was terrible. Second, consider growth sustainability. A company growing at 50% for 2 years might slow to 10%. Always look at the 5-year average growth, not just recent spikes. Third, sector math. Rupees IT stocks often trade at a PEG of 1.2 to 1.5, while FMCG stocks may trade at a PEG of 2.0 to 2.5. Compare within a sector, not across sector. Rupees. Let us run a real example using today's data. The Nifty 50 PEG ratio is 2.05. This means Nifty's PE of 20.26 divided by earnings growth of roughly 10% equals 2.05. A PEG above 2.0 nationally signals the broader market is slightly expensive relative to earnings momentum. So be selective. Stick to quality large caps through regular mutual fund SIPs. For individual stocks, I use PEG as a primary screen. I only dig deeper into stocks with a PEG below 1.5 and strong quality scores, such as return on equity above 15% and debt to equity below 0.5. Then I run my full 3-pillar analysis, which includes quantitative, DCF, and qualitative factor. Rupees for regular mutual fund investor rupees you do not need to calculate PEG yourself. Top fund managers already use it. The SBI Focused Fund, for example, has an alpha of 8.41 and manages PEG exposure across its portfolio. Let the professionals handle the math while your SIP builds wealth. Remember, a low PEG is like finding a diamond. It is valuable, but only if you verify it is not cubic zirconia. Always combine PEG with management quality, moat analysis, and the guidance of a trusted mutual fund distributor. Now, here is what you can do this week. First, open your list of current holdings. Calculate the PEG for each using the 5-year earnings CAGR. Flag anything with a PEG above 2.0 for review. Second, for any stock with a PEG below 1.0 and a quality grade of a plus according to our 3-pillar system, consider adding it through a disciplined accumulation plan. Third, schedule a 30-minute portfolio checkup with your mutual fund distributor this month. Share your PEG analysis with them. Dada's wisdom is this. The PEG ratio is a beautiful compass, but your portfolio needs a captain, not just a compass. The captain, a trusted mutual fund distributor, knows when to hold steady and when to change course, no matter what the compass says. Remember, investment in the equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Past performance is not indicative of future results. You have the courage to ask the right questions. Now, go out there and build your future with confidence. This is Investment DADA, signing off. Until next time, stay wise and stay invested. Thanks and regards, Kaustav Bishwas from Plan Future, welcoming you to visit our website. Data and AI driven, your personal navigator and co-pilot for investment analysis.